is a financial news breakdown. It's analyzing AMC's recent 6% stock rally.
Right.
It links that jump to the Wicked movie release, but also gets into the mixed Q3 earnings and that really crucial December share dilution vote.
That is the perfect summary. And because this material is for an audience already deep in the weeds here, we really need to dive right into the core financial conflict.
Okay.
So while the material correctly identifies the December 10th vote, the one to double authorized shares, as the most critical part, the analysis would be so much stronger with a more rigorous exploration of the specific financial trade-offs.
I see. So a key theme here is this sort of existential tension, right? Leading up to December 10th. This huge risk in doubling shares from 550 million to 1.1 billion.
It is.
And the weakness right now, I think, is that the framing makes it a simple dichotomy. It's either dilution or the company survives. It doesn't really get into the scale of the debt reduction needed versus the real severity of that dilution.
Exactly. It implies this is a necessary evil, but it doesn't quantify the potential benefit against the existing burden. The listener who's following every single earnings report, they know the debt is around $4 billion.
Right.
They need to hear how the math of that debt actually intersects with the different capital raise scenarios.
$4 billion is a huge anchor. So before we even get to the dilution math, can we contextualize that? I mean, what are they paying just in interest every quarter that makes this whole thing so necessary?
That context is absolutely crucial for grounding the analysis. We can estimate that the annual interest expense on that $4 billion is somewhere in the range of, let's say, $350 to $400 million.
Wow.
It could even be higher. And that means every quarter, they are shelling out nearly $100 million just to service the debt. That's not even paying down the principal.
$100 million a quarter?
That $100 million is the baseline hurdle we need to be thinking about.
Okay, that completely reframes the problem. So our suggestion for improvement, then, is to integrate a brief but really rigorous scenario analysis to ground that risk-reward calculation.
Yes.
We should shift the emphasis from the, emotional side of dilution, which the expert audience already gets, to the actual cash flow improvement needed to clear that $100 million quarterly interest payment.
That is so actionable and immediately elevates the professionalism of the piece. For some concrete examples, instead of just saying, your slice of the pie gets smaller.
You put a number on it.
You put a number on it. We could offer a calculation that uses those interest payments.
Like, to make this actionable, consider how many of those new 550 million shares would need to be issued, say, at the current $2.20 closing price, just to cover 1 quarter's interest payment. That puts a real price tag on the necessity of this vote.
Precisely. And building on that, we should suggest contrasting the Q3 net loss, that $298 million, directly against a hypothetical capital injection. Say they raise $200 million from the new shares.
Okay.
Show the actual runway the company is buying if the vote passes. Show them the tangible difference between the current loss and that potential cash cushion.
And we should also maintain that realistic tone by talking about the risks, right?
Of course.
How does the material address the risk that even if the shares are doubled, a cash crunch might still happen if the market price falls way below that $2.20 mark when they actually go to issue the shares?
Yes. Acknowledging that calculation needs to be part of it.
It shows you're credible.
It demonstrates a comprehensive understanding of these financial maneuvers, not just the best case scenario, but, the structural vulnerability you have when you're using equity financing at these valuations.
That's extremely helpful for grounding the analysis in hard numbers. Now, let's shift to the company's forward-looking strategic spending. The material introduces CEO Adam Aron's GO plan, this billion-dollar investment in things like laser projectors and better seating.
It's detailed, but its strategic placement feels completely detached.
How so?
Well, the material introduces the GO plan, but it just fails to strategically connect this huge long-term investment to the immediate crushing crisis of the $4 billion in debt.
I see. So the weakness is that putting the GO plan in its own separate segment makes it feel like a concluding positive footnote.
Look over here, shiny new things, kind of distraction.
Right. Instead of a calculated business decision, it's disconnected from the urgent reality of that $298 million Q3 net loss and the dilution vote. The material calls it playing offense, but it doesn't clarify the funding source or the immediate impact on cash flow.
Which makes the company look strategically inconsistent. Or even reckless.
Yeah.
That's the critical point. The audience needs to know why spending $1 billion on upgrades is a responsible choice when the house is still on fire with debt. If we don't justify it, a professional listener is just going to see it as gross financial mismanagement.
That's a powerful reframing. But how do we make sure the audience doesn't see that billion-dollar plan as reckless, given the debt?
Our suggestion is to reframe the GO plan as a critical piece of the Q3 strategic update and of the debt reduction strategy itself. You explicitly argue why this spending is justified while they're holding this massive debt pile.
So you strengthen the whole narrative. You turn the spending into a necessary investment for survival.
Exactly.
I like that. You make the expenditure part of the solution, not a distraction from the problem. The goal is to justify it as essential for protecting their high-margin revenue streams.
That's the angle. For concrete examples, you could weave the GO plan details directly into the Q3 analysis section.
Okay.
Emphasize the economic rationale. If the revenue beat of $1.3 billion and the record spending on food and drinks, the high-margin part of the business, if that's the good news,
then the billion-dollar investment is what's required to maintain that record spending.
you got it. The argument becomes that the GO plan is essential for revenue defense. It secures the premium experience that gets you the high-margin concession sales, which in turn is the only way they generate the operating cash flow to even approach servicing that debt.
It makes the debt a necessary evil to facilitate those future premium revenue streams.
Yes, and you could suggest contrasting the record numbers on food and drinks with the need for that premium seating. You're arguing the GO plan is there to protect the existing high-margin business.
And to really drive that point home and tie it back to our first critique, we should tell the author to ask a probing question in the script itself.
Like what?
Something like, does this $1 billion investment actually rely on the dilution vote passing?
Explicitly linking them.
Yes. Linking the GO plan's funding to the dilution proposal would create a sharper, much more integrated conclusion. It shows that all these financial decisions are connected.
And it creates a narrative where dilution isn't just about survival. It's about investing in a necessary future cash flow engine.
Okay. That leads us nicely into the overall narrative structure. The material does a great job of identifying the core tension, but the way it opens the story could be stronger, more immediate.
I agree. That's a foundational element we need to address to align the opening with that professional tone the rest of the analysis is aiming for.
So what's the issue exactly?
Well, the script accurately labels the 6% surge as a hype rally driven by wicked and oversold conditions. But that initial focus on market sentiment overshadows the core fundamental conflict that should anchor the entire story.
So the weakness is that the opening sounds, too reactive to market noise? The question of, is this a dead cat bounce or is the ape army onto something? You think that delays the sophisticated analysis that comes later?
I do. For an expert audience, that framing can feel a bit like filler. It compromises that intended professional, realistic tone by leaning a little too heavily on retail investor jargon and day-to-day volatility.
I see your point. The analyst is focusing on a 6% move when the real structural issue is a multi-billion-dollar debt load.
Exactly. We want to use the market movement as a starting point, not the destination.
So the suggestion is to use the initial catalyst, that 6% rally in Wicked, as a prompt to immediately frame the central question.
Which is?
How does temporary box office success fundamentally address a structural debt problem? You start the analysis with the core financial conflict, not the cultural hype.
That instantly raises the analytical stakes. It sets the expectation for a rigorous critique. We need to grab the listener with the central conflict, not the market chatter.
For concrete examples, we could propose restructuring the opening, make the headline news, the rally collide, immediately with the fundamental reality.
Something like, today, AMC is up 6% thanks to movie hype, but that temporary surge is running headlong into a $4 billion debt wall and the looming December 10th dilution vote. That is the real story we need to track.
That's strong.
And the 6% gain barely registers against the cost of servicing that debt.
Another powerful option would be to use the Q3 revenue beat of $1.3 billion versus the $298 million net loss as the opening hook.
Ooh, I like that.
It immediately presents the core financial paradox.
Yes, showing the paradox of high revenue meeting crippling interest payments. That establishes your analytical foundation before you even mention Wicked as just a recent fluctuation. The story then becomes, how is the company managing this massive internal tension?
And finally, to maintain that professional tone all the way to the end, we should ensure the closing line is less about market tribes, less about the ape army, and more about the quantifiable Q4 box office projections needed to demonstratively chip away at that $4 billion debt mountain.
Right through to the end. The closing should leave the listener with a clear, numerical expectation for the company's performance, not just a feeling about market sentiment.
This has been an incredibly focused critique. I think it will really help maximize the impact of the piece for an expert audience. So, to summarize for our listener, the key opportunities we identified revolve around deepening the financial rigor of that December 10th dilution vote.
Yes, we need to see the math, the specific calculation of how much cash they need versus how many shares they have to issue, and really understanding that implied interest burden.
Absolutely. And second, the material needs to strategically integrate the $1 billion GO plan investment with the immediate debt crisis.
Don't let the capex look like a distraction. Justify it by linking it to the necessity of premium revenue generation to service that huge debt load.
And finally, sharpen the analytical angle. Foreground the debt and the financial fundamentals over the market hype and temporary rallies. Use the hype as a springboard to launch into the sophisticated analysis of the company's structural challenges. Don't lead with temporary market noise.
Implementing these steps, deepening the math, justifying the capex, and restructuring the narrative focus will make the material so much more robust, more logical, and fully aligned with what an expert audience expects when tracking this complex financial situation. We genuinely look forward to seeing the revised draft when you resubmit it for another review.